Good evening, everyone. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Crypto Tuesday, February 22nd, the year of our Lord 2022. 2022. Unusual. Yes, it is. And on Crypto Tuesday, it is tax season. So let's talk about taxing cryptocurrency. Won't you join us? Well, thank you so much for joining us again on today's Tax Talk. I like when I could talk about crypto and taxes. We don't always do that. We talk a lot about other kinds of crypto and what's going on with the blockchain. And sometimes we talk about NFTs and how they're taxed, and the decentralized autonomous organizations and how they raise money. And it's all about money and taxing and things like that. But we're very interested in the whole blockchain phenomenon. And it is a phenomenon. But today we're going to talk about taxing crypto because it's it's tax time, and we're going to go ahead and talk about it. So let's jump right in. As is our wont, we begin by let me go back. We begin like we do every week at coinflip.tech, our favorite crypto ATM company, and we go with the markets, and we'll see that the markets today are up. So Bitcoin's up 2.48% today, and Ethereum's up 1.22% again today. We like to look back from last time we were together last week on Crypto Tuesday, and we see that the while it's up today, it's been a kind of a down week. It seems to be a reoccurring theme. Because it was like that last week when we came in. It went up fairly steep from the Monday to Tuesday last week, and it looks like it's doing that again today. Well, it's not that steep, but it is up today, and it looks like it's been down for the week. So let's look at that was Bitcoin. So let's look at Ethereum. Same thing here, right? Again, as we talked about last week, they seem to mirror each other. Very closely, and another week where that's the same. They do kind of mirror each other. So it's kind of a down week. So it's not the roller coaster. Seems like the roller coaster is going down. We can get on the roller coaster going back up. Okay. So here's the article I wanted to talk about. Decrypting tax season, how to understand cryptocurrency taxation. Now, here on today's Tax Talk, we've talked a lot about crypto and how to tax it, how the IRS looks at it. We've done all of this, but I think it's a good refresher to talk about it in tax season and remind everybody how it is. And maybe you didn't catch that episode of today's Tax Team. Well, you should. You should always catch the episode of today's Tax Talk. And remember, I'm going to ask you to like and share this content. Who else is talking about taxes every day? Remember, the taxes are the core of all news, except for the violent news. And sometimes it is the violent news. Sometimes. But anyway, decrypting tax season, how to understand cryptocurrency taxation. Very good article. Reporting cryptocurrency transactions to the IRS can be a complicated process. Boy, don't I know it. And while the IRS has put together a helpful FAQ, the Illinois GPA Society encourages taxpayers to partner with a CPA, or a tax attorney, in my opinion. Cryptocurrency investing and spending was a hot topic again in 2021 as the likes of Bitcoin, Dogecoin, Ether, and others set record high valuations and their commercial use became more widely accepted. Think Tesla accepting Bitcoin and Dogecoin as forms of payment for its electric vehicles, and many high-profile athletes and public figures taking their salaries in cryptocurrencies. But as cryptocurrencies catch the attention of more investors and consumers, they're also drawing more scrutiny from regulators. And it's, again, another big topic that we talk a lot about here on today's Tax Talk, including the IRS. In fact, as we head into the tax season, the IRS promptly asks, and I should have brought that form up, because right there on the first page, 3 years ago, the 1040 had it on Schedule A, and they asked that question. Last year, 2020, it was right there on the first page, as it is today. At any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So that's right on the first page now. You answer this. Remember, you're answering everything on your tax return under penalty of perjury. So you got to be honest. So as taxpayers prepare their 2021 tax returns, here are the top things to remember when following the IRS guidance for reporting taxable cryptocurrency purchases, sales, trades, and transactions. Generally speaking, buying cryptocurrency isn't a taxable event. If you hopped aboard the cryptocurrency train in 2021 and bought any cryptocurrencies but didn't trade or spend them, you probably don't owe any taxes on them. So far, the IRS has outlined the following taxable situations: selling your cryptocurrency for cash, trading one cryptocurrency for another, using cryptocurrency at a merchant as payment, including via cryptocurrency-based debit card, receiving airdropped tokens resulting from a hard fork, staking or mining cryptocurrency, being paid in cryptocurrency. In other words, if a taxpayer simply purchased a cryptocurrency and continues to hold it in their brokerage account or digital wallet and didn't sell, trade, or exchange it, there's likely no tax consequences or additional reporting required. Gifting or donating cryptocurrency or transferring it between exchanges or brokers are also non-taxable events. Cryptocurrency is the subject to capital gains tax, again, different than income tax, although, as we'll get to, some of it is subject to income tax. In the IRS's eyes, cryptocurrencies are property and are generally taxed like stocks. So when cryptocurrency is spent or traded, those are taxable transactions, and taxpayer must report the capital gains or losses on their tax return. The capital gain or loss is based on the difference between the accusation cost, we call that basis, and the sale proceeds and the holding period. If you hold something for less than 1 year, a property like this, then the capital gains is a short-term capital gains. If you hold it for more than 1 year, it's a long-term capital gains, different rates. When you're paid with cryptocurrency, it's treated as income at the fair market value of the digital asset on the date you receive it. As cryptocurrency becomes more commonplace, so too is being compensated with it for goods and services. Employers who use cryptocurrency for wages or to pay for goods and services must still report employee earnings on W-2 forms, withhold the same amounts as if they're paying wages in dollars, and convert the value of the cryptocurrency to dollars on the date of payment. Self-employed taxpayers who accept cryptocurrencies for their goods and services must track the transaction dates and values in dollars as the transactions occur to report the income and capital gains or losses when filing their tax returns. It does require more paperwork and more tracking. Your records have to be very good about when you received it. What was the value at that date? Very important. Careful tracking is key. I thought I just said that. It's up to the taxpayers investing and transacting in cryptocurrencies to track any possible taxable activities. That's why it's so important that you understand what the taxable activities are. Because a lot of people do not. And they're investing in crypto without really understanding what's taxable, what's not taxable, what records they should be keeping. Unlike traditional stock investments, 1099-B forms aren't required to be issued to cryptocurrency investors by exchanges. That means you don't really know what they're not going to tell you what the basis is. And so that you have to keep control of that. As such, it's recommended to keep a detailed log of all cryptocurrency transactions throughout the year to ensure accurate reporting to the IRS during tax time. Reporting cryptocurrency transactions to the IRS can be a complicated process, and while the IRS has put together a helpful frequently asked questions, the Illinois GPA Society encouraged taxpayers to partner with a certified public accountant for assistance with accurately reporting cryptocurrency transactions all year long and properly filing their tax return during tax season. The Illinois CPA Society free Find a CPA directory can help taxpayers find a trusted. Well, I'm going to skip that because here's what you should do. You should contact the Open Tax Advocates because they help people with this kind of problem. Now, we don't do normal tax returns for people, one and done. If you want to engage us to help you solve not only complete your tax return, a compliance tax return, but if you're interested in planning, tax planning, and how to reduce the taxes that you owe legally, well, that's something we can help you with. That's what we help people do every day. So this is that's a very good article, and now there's a couple other articles I wanted to talk about. I'm just going to highlight them and not really spend a lot of time on them. Last week we talked a lot about NFTs. Explain what are NFTs, how it is different from cryptocurrency. How are they different from cryptocurrency? Non-fungible tokens have, thanks to the ability to assign value to everything from art to music to a simple selfie, taken the world by storm. The sales of NFTs surged to $25 billion in 2021 as the crypto asset exploded in popularity, fueled by the rising interest of celebrities and tech evangelists, according to the market data tracker. However, some experts believe NFTs are a bubble which might pop. Anything that can be converted into digital form can be an NFT. Everything from your drawings, photos, videos, GIFs, music, in-game items, selfies, and even a tweet can be turned into an NFT, which can be traded online using cryptocurrency. But what makes the NFTs unique from other digital forms, is that it is backed by blockchain technology. For the uninitiated, blockchain is a distributed ledger where all transactions are recorded. It is like your bank passbook, except all your transactions are transparent and can be seen by anyone and cannot be changed or modified once recorded. NFTs are gaining massive popularity now because they are becoming an increasingly popular way to showcase and sell your digital artwork. Billions of dollars have been spent on NFTs since its inception, which date back to 2015. Okay, so that's where I'm going to leave it. That's a very good article. Why blockchain alone won't solve today's privacy woes. Again, just another survey of another article that I'm reading that I'm interested in, right? Because I believe blockchain can be a very strong. Let me talk a little bit about this. I think the promise of blockchain is monumental, as was the promise of the internet. And I believed at one time that the internet may give us much more freedom. And as it turned out, not so much. Now we're being controlled more, in my opinion. People are, look what's going on in Canada. Where they're going after bank accounts, and they know this because of computers. They can get this information, and so while it was a promise of freedom, it's turning around on us as enslavement, in my opinion. Blockchain has the same promise and danger, in my opinion. It may be a very freeing technology that allows us to know and keep our privacy and keep everything open and honest, or it may be used to enslave us. Which one is it going to be? Don't know yet, right? But again, the promise is there, as is still the promise of the internet. We're going to blockchain, which is the W3, the Web 3 is coming. And that uses much more blockchain The hope is that it's going to free us up from all of these large companies who control us. I guess we'll see, won't we? Okay, so this is protecting privacy across the internet has never been more important. COVID-19 has sparked an unprecedented growth in digital services and pushed more people into the online world. Due to this, we must ensure that users' data is protected and they have full control over what information they share, especially as data breaches and hacking are on the rise. Decentralized technologies have the potential to provide a solution through applications that allow people to only grant access to their information using the blockchain-based private key. Whilst these solutions can provide users with greater control of their online data, it is essential that the full privacy in the decentralized realm is also upheld as blockchain alone can't solve for full privacy and confidentiality issues still remain. The internet brought up with it many benefits, such as allowing people to conduct business online and connecting people across the globe. Yet data breaches still occur every day, from Facebook leaking over 553 million users' personal information to Microsoft accidentally exposing user analytics online. The examples are endless. This exhibits the need for better privacy across the web. Many users aren't aware of these risks and don't consider who can access their personal data, especially from centralized social media platforms. Exposing this type of private information leaves it vulnerable and at risk of breaches and exploitation, which can be dangerous if placed in the wrong hands. Luckily, the continued development of blockchain technology signifies a large collective effort to offer more secure platforms across the web. The development of centralized technologies has outstripped the growth of adequate data protections suitable for online interoperational services that drive data-driven economy. This means that it is somewhat easy to hack or lose sensitive information across these databases, as they exist in silos protected by systems less suitable for online interoperational services. On the contrary, blockchain technologies, different information is shared with a number of systematically connected parties, making it much harder to tamper with information. Blockchain technologies facilitate ideally online interoperable services and allow for solutions that put the users in control of their data. Despite this, it is vital to remember that online users must also take responsibility for their own personal data and what they choose to share with the online world. Integrating the physical and digital world through decentralized technologies means that users can place a deeper level of trust in the internet. While blockchain systems provide an added level of trust and offer users more control over their data, privacy and confidentiality is still an issue. This is because the shared nature of the distributed ledger technology means certain information cannot technically be private for a given user. Luckily, the combination of blockchain technology with another type of distributed cryptography known as secure multi-party computation can help enterprises to experience the advantages of decentralized technologies while still guaranteeing that data remains private and secure. With the internet continuously expanding and evolving, successfully storing private data and safeguarding sensitive information has never been more important. It is essential that privacy and security remain at the forefront of our concerns, and that blockchain technology is in combination with MPC can remedy this. Again, I thought it was an interesting article, and I wanted to share that with you. So we talked about NFTs, we talked about blockchain, we talked about taxes, we talked about cryptocurrency. And that's what we do here on today's Tax Talk. So remember, we're going to ask you to like and share our content. We're trying to get it out to everybody. We'd like, though, that nobody else is out there talking about taxes every day and telling you what's the latest news on taxes. But that's what we do. So we're going to ask you to like and subscribe. We need your help. So please help us. We need your help to like and subscribe. And as we do every day, I tell you, if the first thing you do when you're fighting the IRS and you don't know what to do, the first thing you do, you get a copy of my book, Deal with Your IRS Problem Today. Go to freeirsbook.com, freeirsbook.com, get a copy of my book. So thanks so much for joining us here today. We really appreciate it. And we'll see you again here tomorrow. Out.